Today on the show, I have the pleasure of speaking with Bob Fraser. Bob is on a mission to help investors take advantage of one of the most effective and overlooked avenues of real estate investing, which is residential mortgage notes. As founder and principal of Aspen Funds, Bob has purchased more than 1,000 notes, earning him and his company double-digit annual returns without the risk and volatility of the traditional investing options. I'm really pumped and excited to have him on the show today to share his incredible insight into the mortgage notes industry and really to share his background and experience with you all. So without further ado, Bob, welcome to the show. How are you doing today, mate?
Great to be here.
Mate, thanks for joining us. You're dialing in from Kansas City, is that right?
Yes, sir.
Awesome, mate. Well, the first question I ask all my guests before we dive into the nuts and bolts of today's show is, rewind the clock and tell me how you made your first ever dollar as a kid.
Well, peeling onions in a Japanese restaurant.
Really?
So, yeah. So I decided I didn't want to work in restaurants anymore after that. And,
what age were you? Mid-teens?
I think, I was probably 14, I think. And, they set down a 50-pound bag of onions in front of me with a knife and said, it's amazing. I think I was working for $1.25 an hour.
Wow.
Amazing how many onions they got peeled for $1.25. And I remember thinking, this is not the math I want to have anything to do with in the future,
Well, but it gives you a sense of what it takes to earn a dollar, right? And
it sure does.
And those sort of, when I say hard grafting type of roles and jobs makes you realize, okay, I need to go out and use my brain, not be a machine.
Exactly what it did. What it did. It was actually a very positive experience in that sense.
Exactly. I had a similar upbringing. I remember telling my dad when I was laboring, building pools in the summer in Australia, and 12-hour days, backbreaking type of work in the heat. I was like, I can't do it. He's like, well, that's why you're at university. That's why you're getting an education. So it's sort of pull your socks up and pay attention sort of thing. So
exactly.
So Bob, walk us through the journey of how we've got through to today, and what really got you started along this entrepreneurial journey.
Sure. Well, I always kind of had an entrepreneurial itch, but I became a computer programmer. So I went to school for computer programming at Berkeley and did that for a few years and did super well in that. But it was a job. It was a W-2 job, and always had an entrepreneurial itch. And then in 1995, I took the leap and I started a tech business. It was a super bad business plan, super bad idea, but I was able to convince mom to put in money and started this business. Well, we ended up morphing and pivoting and ended up raising $44 million in venture capital for this business, ended up becoming the fastest growing business in the United States, in the Midwest region of the United States during the late 90s, and ended up winning the Ernst & Young Entrepreneur of the Year Award in 2000 at 300 employees. So it was a real rocket ship and kind of catapulted me into the world of finance and investments. And so that was a great experience, but also heartbreaking because the thing ended, it just completely blew up. And so I learned a lot through that whole period, being worth hundreds of millions of dollars and then to being worth zero overnight. Wow. And so it's very, very formative. And I kind of, just went from a computer programmer, just a normal Joe, kind of a, worker, I guess a knowledge worker, but I wasn't a businessman,
right,
to, really being an investor and a smart investor, building investment, products, that kind of thing. So.
Awesome. And so how did it all blow up?
Well, it was the dotcom crash in 2000. So we didn't make the IPO window. And, people don't realize how fad driven investors are. And the next coolest thing, you're watching it now with the WeWork fiasco. One minute you're a darling, the next minute, I promise you, if you're in, co-work real estate, you can't raise a dime right now. It doesn't matter what your business model is. It doesn't matter how good it is. It's over. And that's what happened in 2000. It just nothing mattered anymore. So people just bailed. And so we missed the IPO window. And then the investors, all the venture capitalists, there's so many different kinds of money. I've raised a lot of money in my days, and there's all different kinds of money, different flavors, and all that money comes with different expectations and different time horizons. And I learned that venture capital, they have about a 5-year time horizon. If they don't, they don't see the exit that they think of in 5 years, they're done. They kind of walk out the back door and get rid of as much as they can, or just liquidate as fast as they can. So it's just it's just a shock for a guy who's just a normal dude, to grow up in this.
It's so incredible that you've gone through from a normal dude, as you say, guy, into starting this company worth a lot of money to then have it all evaporate overnight. I'm sure you've gone to some pretty dark spaces in places during that transition.
Oh yeah, absolutely. Anybody who's, I joke that, my crater is bigger than yours. And, there's not many people I know that have had the ride I've had. But yeah, 2001, I was on the front page of the newspaper before that, and then I was on the front page of the newspaper after that, and the people not returning your phone calls, and you're waking up, just trying to not circle the toilet bowl that day, and it's no fun for a guy who's pretty optimistic, and it is definitely tough times. Anybody, I'm sure a lot of your listeners, went through, crises, and the last crises, the 2008 crash and other things, and they're formative and good if we let it properly impact us, right? Mm-hmm. Psychologists say that one of the greatest predictors of success is resilience, right? And it's being able to positively process through the challenges.
So tell me, what was the biggest mental challenge you faced, and what advice do you give to someone who may not have gone through such a traumatic time as yourself?
Yeah, well, for sure, it's having hope and not letting go of, hey, there's better is yet to come, and I'll get through this. So for sure, you have to have just mental fortitude to get through these things. But I learned a lot of things about money. I learned a lot of things about investors. I learned a lot of things about the type of money I wanted. I also learned a lot of things about the kind of market I wanted, or the kind of investments I wanted. And I realized that I don't want to be in the public markets. I don't want to be involved in the public markets. And that's what kind of led me to real estate. Something that's a little more predictable, a little more control,
And that's a great segue into the real estate space. So having such an incredible, shot to fame, and then the massive crash of 2000.com, how did you pick your socks back up and get into the real estate space? What sort of time frame thereafter 2001 were you looking then into real estate to start reinventing yourself?
Well, I'm kind of a slow learner. So I ended up starting a hedge fund, a public market fund, in 2008, believe it or not, September of 2008. So again, timing, I have a gift of timing, and so that didn't go well. And at that point, really realized I did not want anything to do with public markets and, the investment fads where valuations change overnight, this kind of thing. And so met a partner who had discovered mortgage notes. And this is a guy who had lost everything in the real estate crash, and realized that, the people that were winning were the people on the debt side versus the equity side of real estate. Right. The banks don't really lose that much usually, now obviously they can, but if you do it right, the debt guys are the guys who win. And so he had started looking into researching this residential note market, and had come up with some really amazing strategies. And I was at the time looking for something outside the public markets that just, I wanted nothing to do with any more public market valuation exercises. And so it was a match made in heaven. So we started this business, and, really haven't looked back in the note space. Much better.
Right. And so talk to us a little bit about why you choose the resi market over the commercial market for note investing, and really what's the difference there?
It's incredibly different. Residential real estate is fantastic, but it's very cap rate driven. So it's very driven by interest rates and by institutional investors. So it's very, very linked to the economy. Residential is very linked to earnings, individual earnings. And I can show you that, I mean, so if the economy goes down, well, you still have to live somewhere, don't you?
Mm-hmm.
And you still have to pay rent. So it's far less volatile and far more predictable, far more, it takes, it's harder to get to the bigger numbers. It's hard to build a $10 billion fund. Just you have to have a lot more assets because they're smaller, but it's really a very good space to be in because it's home sweet home.
Right.
People have to live, and so there's a lot of great opportunities in residential.
And when you say residential, and when I say residential, at least, I'm meaning 4 units and under, right? Like, because you can have commercial multifamily, which is also residential, but it's commercial. Like,
that's right.
It's
exactly.
a multifamily asset. It's 100 units. So it's very interesting that you say that because it is what everyone, in 2008, that's what everyone got stuck up on, right? Everyone's trying to buy these homes at this debt, these ninja loans of no income, no job.
Right.
And they're over leveraged to the wazoo, and all of a sudden they can't pay it back.
Yeah.
So in that instance, how are you as the, we talk about the debt side being the more protective side. How are you, how do you navigate that space if you've got people who just walking in and handing in keys and say, I foreclose on me, I don't care?
Yeah, well, we're the bank. So we're the ones, we're the lien lord in that point. So we're the ones foreclosing. And I think, we saw a big run up due to speculation, ninja loans, as you're talking about, shoddy underwriting, and really, shoddy securitization happening. So we saw a lot of run up in the prices of homes and a lot of that kind of thing. But honestly, it's not happening now, and it's not going to happen, in my opinion. It's so funny. We always are protecting ourselves from the last crisis.
Mm-hmm.
You know what I mean? But the next crisis is never like the last crisis, right? And so everybody is so terrified of the 2008 happening again. I promise you it's never going to happen again because everybody's looking for that. It's the new crisis is always going to be different than the next one. But our home prices way out of whack right now, and I would argue from about a dozen different standpoints, no. I do economic research on these things. Our company does this significant investment in economic research. The homeowner is quite well, on a inflation adjusted abasis, homes are, I think, 12% below the peak valuation wise.
The average American home you're talking about, right?
Yes.
Yep.
Yes. And the homeowner, the debt to income ratios are very low. Homeowner is very healthy. Foreclosures are very low. So, and underwriting standards are still very high. So all these things, I'm arguing that I don't think houses are overpriced, especially in the Midwest regions of the United States and geographically, as well as the fact that single family homes have been massively underbuilt for the last 15 years. Very little new single family construction. And I can show you all the charts on this, but it's, just a huge shortage of single family homes. And so again, I'm just not seeing that we're not going to see it crash like we saw before.
And maybe we can just sort of some really great golden nuggets there, because I want to maybe dive a little bit into that. Can you maybe just explain to the listeners, in your opinion, you talked about the underwriting, and I mentioned ninja loans. So how did the change and this PTSD, I'll call it, from 2008 change the way in which we underwrite today, which is making it more fundamentally safer, in your opinion, that we won't see the same recession like we saw in 2008?
Well, and as you pointed out, it was home underwriting, shoddy underwriting. With the ninja loans, you can get. I've heard that you can get ninja loans, but I haven't seen them. They're certainly not very common, if they are at all there. For example, in 2006, about 50% of the originations were in the 500 below 700 FICO. Today, only 20% are below 700 FICO. So just if you look at the originations, the lowest FICOs being underwritten in 2006 was around the 500 640 range. Today it's around 620 range, the lowest FICOs that are being approved for standard loans. So the underwriting is far better at this time, far more conservative.
And do you have any opinions on the DoddFrank, regulations that came into place? Are you of the school that those need to be loosened, or you like them, the fact that we did fall into a ditch and we now have slapped ourselves over the wrist with these restrictions in order to make it?
And which restrictions, which part of Dodd-Frank are you?
Well, there's so much of it, in terms of how much banks need to have on hand, in terms of there has been murmurs in the markets that banks need to loosen up with their lending criteria. Are you of that school of thought that yes, we need to loosen up, or we're going to stay the course with these, better FICO scores, better underwriting, better making sure that we're not going to shoot ourselves in the foot round two?
Honestly, being in the mortgage market, I think it's pretty healthy right now. If you want to, get a out of the box loan, you can get them, and you can pay 8% for non-conforming loans. So it feels to me like it's pretty balanced. All in all, I think Dodd-Frank should probably be repealed. The capital requirements was good. The bank capital requirements, people don't realize, in Europe, 20 years ago, banks only had to have about 1% of their capital, against their assets. It's insane, right?
Right.
In America, we've always been around 12%. And so it's very conservative. Our banks are really not in trouble right now. I like that. I think the Dodd-Frank, the one thing I think that should have been implemented, we're getting into, my opinions for sure, but that was never implemented, was the Volcker rule, separating banks from investment banks. And, look, if you're lending on someone's home, you shouldn't be rolling the dice on your own portfolio as a hedge fund, all right? Right. And so the Volcker rule should have been implemented, and this one, for whatever reason, they never had the stones to do it.
Right. Interesting. Well, mate, let's talk a little bit about we spoke about the old crisis, right? In the mortgage sector, is there going to be a new crisis coming up in terms of lending? And I'm not just talking about house lending. I'm talking about other the debt crisis that could happen in terms of, you briefly mentioned the WeWorks of the world and these overvaluations and that sort of commercial industry debt that we're saddling up with. Do you have any opinions on that?
Yeah, I think there's trouble brewing in the student loan world, but who's not to say that we don't get Bernie Sanders elected and it all evaporates tomorrow, gets paid off, Right. So the next crisis is always hard to predict, right? We're always predicting the last one is going to repeat itself, but that for sure it doesn't happen. Okay. Right. Right. That's the only one we sure of is what's not going to happen.
Interesting.
But yeah, I think that public market valuations are in certainly nosebleed area. Certainly, commercial real estate, multifamily, has the cap rates ever been lower?
No.
Some of these multifamily sectors, I would be building and selling into those markets. I wouldn't be buying in those markets. So I think there's a bit of a bubble in some of those, cap rate driven places, but on the other hand, I also think the economy is going to continue to be strong for a while. So right. I don't think there's imminent risk.
Yeah, no, it's interesting. You spoke briefly about the lack of new single family housing. On the other side of the coin, there's been so much multifamily housing being built because of the way in which we're changing our demographics of where we want to live. We want to live closer to downtowns. We want to live closer to works. We don't want to commute as much anymore. All this sort of this lifestyle over, having this American dream of owning your own house. So, and that's not going just about America. Like I come from Australia, same things happening in Aussie, right. Same things happening in Europe. It's wages aren't keeping up, but the cost of living is going through the roof. You don't have to spend 2 hours in the car commuting to and from work and then go somewhere else for groceries and all that sort of stuff. So we're definitely seeing a change in the way in which we as humans interact and house. And I think that's where you've seen the multifamily, which is forced cap rates to be lower. How does that, I think we are also in a very much a frothy bubble for multifamily because that's the market I'm in. So it's interesting to see where that next cycle is going to hit, and I think right now there's a lot of flight of capital to the multifamily markets because of the cash flow and the appreciation.
Sure.
You know, the balance of both. But in your opinion, what do you have anything to add to that in terms of that type of the frothiness we're seeing in particular multifamily?
You know, again, I study global markets.
Mm-hmm.
Well, if you look at one of the biggest forces on the planet right now is these negative interest rates coming out of Europe.
Yep.
You know, as well as all the money printing coming out of Japan, People's Bank of China, et cetera. And so if you're a European investor, you run a pension fund, and you're staring at negative 1% interest rates.
You're going to pay.
What are you going to do? Well, you're going to do anything but buy that bond. You're going to look at currency swaps, and then you're going to start scanning the markets for any kind of return you can get. And multifamily looks good, and it does. But the problem is a small change in cap rate means a huge change in valuations, and so. It's riskier, but people are willing to take that in the face of negative interest rates. So I think it's causing all boats to float.
Right.
And meaning all fixed income investments, including bonds, everything else just goes up because of this tide of money, from Europe and Asia.
To try and get a bit of yield somewhere.
That's right.
That's essentially what you're saying.
Right.
So I know you're in the mortgage, but I do love your thoughts on where we're headed. Do you think we're in a low to zero interest rate market, or do you think we're going to rebound and get back to the days of 4, 5, 6%?
And I actually make an economic forecast. I update it quarterly for my clients. But yeah, I believe that we are in a low interest rate environment for the foreseeable future, to be honest, Reed. Mm-hmm. And the reason is this. So what happened is traditional economics, when you have easy money policies, it creates overheating in the economy and inflation, right?
Right.
And what happened in 2009, when they responded with these incredible, I think the US, they purchased $3.7 trillion worth of bonds, the Federal Reserve did, printing money, basically monetizing the debt. Mm-hmm. No hyperinflation. Explain that. You look at the same thing, and Mario did it in the ECB. The Japan is still printing money. I think they own something like 80% of the country's ETFs. Believe it or not, the Bank of Japan is insane. Where's the hyperinflation? Well, here's the hyperinflation. The hyperinflation, all that money has been flowing into assets. So you're seeing housing prices, multifamily, everything going up. But it hasn't translated into consumer prices. Okay, so let's have two kinds of inflation, right? There's asset price inflation and there's consumer price inflation, right? One we don't call inflation, right? It's asset prices. We like it when the stock market goes up,
right?
When our house prices goes up, when our multifamily thing goes up. We don't like it when our price of milk goes up and beef and these things, right? Rent. Well, here's the deal. Since 2000, we have systemic deflationary forces at work in consumer prices. So if you look at wage deflation is dramatic due to globalization and due to automation, right? I just went to McDonald's the other day, and they've now got a digital kiosk to order. I mean, jobs are disappearing because of automation. They're now, I've got a son who works at a gold mine, and they're replacing all the trucks with self-driving trucks, disappearing 3 drivers per truck, 3 shifts, 24-hour shift. That's $300,000 a year in savings for one truck. Mm-hmm, mm-hmm. Wow. I mean, so wage disinflation, right? Then you've got energy disinflation. When you look at, do you know who the largest oil producer in the world is today? It's America.
Is it?
It is America.
Huh.
We took over in 2013, #1 producer of oil. Well, what happened was the fracking and horizontal drilling revolution. It's technology. What happens when that technology is deployed in the giant and supergiant fields in Russia, in Siberia, in Saudi Arabia? I promise you, we've seen the end of $100 oil forever.
Do you think
And
it'd be less than that?
not only to mention the fact that the oil consumption, for example, in America, now in China it's still growing, but in America it's flat.
Mm.
Our oil consumption is actually fairly flat. And conservation is working. And then you look in technology again. I'm a technologist, I'm a computer scientist.
Right.
I apologize for my nerdiness.
I love it.
But
Love it.
you look at a guy named Jonathan Goodenough, just won the Nobel Prize for chemistry. He's the inventor of the lithium-ion battery. He just won the Nobel Prize for a new battery called the solid-state battery. Has 3 times the power density and instantaneous charging. You plug the battery in, it's charged.
Wow.
It'll change there. It'll be the end. You've seen the beginning of the end of gasoline-powered automobiles. I believe by the time you're an old man, you will recall the days when automobiles had gasoline engines.
I completely agree.
So, at the end of high-priced oil, you look at, the biggies on consumer price inflation is food, energy, and wages. I just hit wages and energy. Food, we're having massive disinflation in food because, again, of technology. We're seeing the number of hectares in the world being harvested going down, but we're seeing the productivity per hectare going up dramatically.
Right. And that's really important.
In Brazil, they're doing 3 harvests per year on the same piece of land, because of technology. So bottom line, is that stuff going to reverse anytime soon? No.
Right.
And so we're seeing, I believe we've seen the end of high consumer price inflation. Well, that's the gating factor that keeps interest rates from being raised.
Right.
If consumer price inflation begins overheating, that's when all the banks the federal, global banks will start raising interest rates. But we're not seeing it. So there's no price to pay. Let's have easy money until it hurts. Well, it doesn't hurt yet. And it's not going to hurt. So what's happening, they're going to continue easy money policies, and it's going to continue increasing the tide where all boats float, meaning asset prices, including the stock market, by the way.
And so when will it start to hurt, in your opinion?
When will it stop?
No, so when will it start to hurt? You talk about the low interest rate environment. When will low interest rates start to hurt us?
Yeah, that's hard to see. I'm looking at some of the, watching the election, of the Democratic, figures and,
side of the party,
with their kind of insanity of, I think I saw Elizabeth Warren's, Medicare for all. I believe it was $54 trillion in costs. And by the way, you're from Australia.
We haven't.
Is the medicine more primitive in Australia? No. Yeah. And yet it costs, I think, around 4 times to get a hip replacement in America than it does in a place like Australia. What's going on? Right. So the answer is not just.
No, there's fundamentals there, and we can get into all of that.
And so anyhow, I see there could be real problems if the spendthrifts come in and just really start just let's spend money like crazy, and because the truth is they can probably get away with it right now because our economy is so good, and because we are having systemic deflation, the truth is our government can spend a lot of money right now and it won't be onerous even if they printed it. Right. So sooner or later some public figures are going to figure that out, and they're going to start helicoptering money to the populace in some form, and that will probably not go well.
And you bring up a very interesting point, which is you spoke about short-term, debt cycles and long-term debt cycles, but also the productivity is very important. That as technology grows, and you being a technology buff, essentially our productivity increases, even with jobs losing. We're automating, and yes, globalization has occurred, but automation has also occurred through technology.
That's right.
And that is where productivity continues to, of course, someone, fires 3 employees for 1 truck when you can just automate it. It's that the productivity is clearly going to go up. So when the productivity continues to go upwards, that is when your out product, I can then go and get that product and pay product for when the credit is low and cash is higher, because if through printing money, I can still exchange for goods and services and keep not a job, but innovation going for higher productivity over the long term.
That's exactly right. And GDP equals population times productivity.
Right.
So there's two ways to increase GDP. It's increased population, right?
Mm-hmm.
If we had just one person in America, we'd have pretty low GDP, you know.
Right.
Or increase productivity, and productivity is increasing. It just
which is where we get into the whole with I'm going to replace your son who's got replaced with a truck, and where does he go, right? And where does he get fed, and where does he get housed, and where does he go to school, and all that sort of stuff. And that's where we're really trying to grapple as society. And this is not just in America, this is across the world, with this globalization type of mantra, and how do we reinvent ourselves as a race?
It's a big deal. You're a young man, and your generation has got to solve some of these problems. Mm-hmm. I personally believe we need to make the junior colleges free in America. 100%. I want to write a platform for the politicians.
You should
have a middle of the road platform. It just really, we can afford free junior college, which helps people get learn small engine repair or HVAC repair or nursing or some job where they've got a skill that a computer cannot do.
And you're completely correct. Like, because you look at somewhere like Germany, where they've had trade school as a thing. Like, coming out of high school, it's in Australia a little bit as well. It's okay to go get a trade. Like, you don't have to go to university. And this whole pedestal, putting university, 6 figures worth of debt, blah blah blah. So you've got to look at fundamentally, back to your comment about the free healthcare. It's a fundamental thing about, to your point, why does a hip replacement cost me 3 times as much in America than it does in Australia? There's fundamental issues, and to your point of, like, how do we, one, re-engage with the people who have been disenfranchised through loss of job and all that sort of stuff, through high house prices, through gentrification, globalization, to then re-entrain them to have a skill that is not going to be replaced by a computer.
We have to figure that out, and to me, the junior colleges are a big part of that.
Right.
And
the world's not getting smaller, right? More people are coming, more mouths to feed. There's more.
Right.
So it's a huge time in our lives we're facing, and we've sort of gone off a bit of a tangent. But I like the fact we've gone off a bit of a tangent, because it is fundamental to how we're successful in investing and how we plan for our future and all this sort
Absolutely.
of stuff. So, and I forgot to even mention that your generation is getting older, and we will live. By the time I'm your age, surpassing 100 may not be as a centurion, as they call them, may not be as
that's right,
as uncommon as one would think. So that means longer healthcare. That means you're more years of unemployment. How are you going to support that? So huge. How do we all? There's no solutions, and I don't have the answers, nor do you. But we can have conversations about it. And I think that's where it's going to start.
And I think there are solutions. I just think we don't know what they are. I think we've got to put our heads together and stop arguing and start work on these things.
Right. Right.
And there's better healthcare solutions. I know Switzerland is way ahead of America, and so is Norway and other things. It's actually cheaper, it's higher quality. I'm not super familiar with Australia, but I think the same.
Right.
We need to learn as America. We need to learn and study those systems and take the best parts of them.
Right.
We need a scientific, nonpartisan conversation about this.
Right.
And so.
And exactly, and we won't solve it all on this podcast, mate. But look, I've really enjoyed the conversation with you today. I want to be respectful of your time. One thing we do at the end of every show is we go into our lightning round of 5 questions. Are you ready to dive into them?
Sure.
Mate, what is the daily habit you practice to keep on track towards your goals?
Most important moment in my day is my coffee. My coffee is the key to success. And in the European mode of drinking coffee, which is to sit quietly and stare out your window with a light conversation, and so I'm a coffee fanatic, and that's my daily discipline.
Love it, and I'm sure it's a moment in your day to take a little bit of peace and quiet before you dive into the emails and the technology side of it, right? Who's been the most influential person in your career to date?
Yeah, well, for me, it's probably quite a bit different. It was 2 gentlemen that I hired that worked for me, my big tech company. They were my president and my CFO. I learned everything I know today about management from people who worked for me. I was a terrible manager, and I became a good manager by watching what they did. And my CFO, same thing. I got a financial education, by being mentored by a guy who worked for me.
Wow, that's awesome. And it probably takes a little bit of swallowing that pill to take education from somewhere, or admitting that you're not good at a skill and you go out and learning that skill from someone who's an employee. So
yeah, I think isn't that a key to success though, is being able to learn no matter what, right?
exactly. If you stop learning, you stop growing. So
That's right.
exactly. Being in technology, and this question is going to be hopefully a good one for you, is what's a tool in your business now? And it could be software or it could be a hardware related. What's the most influential tool that you use on a daily basis?
Well, we're fully digital company. We use Salesforce to manage all of our database of notes, but probably the most influential tool that I use is a tool called Power BI from Microsoft. It's Power Business Intelligence, and it's this incredible. You can aggregate data I aggregate data from my accounting package, from my loan servicers, from Salesforce, and to slice and dice your data and do analytics real time. It's just insanely powerful, and it's tiddlywinks to buy. I mean, because they have a free version, and it's just mind blowing. I show people, the analytics and the level of understanding I have of my portfolio, and it's just truly mind blowing the level of control and insight that you can get from using one of these tools.
That's awesome. Is it Power BI? Is that right?
Power Business Intelligence.
Power Business Intelligence. Okay, I've never heard of that. I'll have to give it check it out. And it's a Microsoft product, right?
Yeah.
Awesome. What's been the biggest failure in your career to date, and what's the one sentence or the one takeaway from that failure that you can bestow?
Well, I think we talked about that, the tech business, and I learned that smart money is not always smart, especially in the long run. And I learned the fickleness of the stock market and public investments and how fad-driven they are. And that's when I decided to get into real estate, and especially the debt side, which is far less volatile and far more predictable.
Yeah, I completely agree. I think you've had an incredible journey, to say the least, and amount of lessons. I could speak to you for hours and hours and hours on your thoughts on the economy and where we're headed. But Bob, where can people reach you to continue the conversation? They want to get a little bit more in your sphere, understand what you do in the note mortgage business. Where do they go?
Go to Aspen Funds, like the tree, funds.us. And if you like, I can also have a page for you in your show notes with my economic presentation.
Love it.
My deck, and show you my current thinking about the economy. I'm a firm believer, having gone through 2 cycles, and paying the price. I'm a firm believer in paying attention to the big cycles. So the waves I don't care about, but the tides I care a lot about. And the funny thing is, the waves are not very predictable, but the tides are very, very predictable.
I'd love to see it.
So that's what I pay attention to, and I write about it for my investors, and I'm determined to be on the right side of the tides as they come in today. So awesome. We'll prepare something for your wonderful listeners in the show notes.
Yeah, and we'll have, again, as you said, we'll have it in the show notes and then available for listeners as well. But Bob, I want to thank you so much for jumping on the show today. I just want to reflect some of the things that I took away, because I was madly writing down notes, and I think the biggest takeaway for me is your resilience, and how you've been able to morph over the years from a tech startup into understanding the ins and outs of smart money, and smart money might not necessarily be actual smart money, and understanding where you get your money from the capital markets, so the public markets, or from the private sector, in terms of being on the debt side, and understanding the value of being on the debt side rather than the equity side. And I think that the real thing that probably what's come out of this, as you reflect on your life, is the gift of the timing of the market. You spoke about that you've crashed into 2001, and then you started a hedge fund company in 2008. Like it's fool me once, shame on you; fool me twice, shame on me. So it's really interesting to just crack open a little bit of inside that brain of yours to see what you know, because you do have years of experience over me and most of my listeners, and it's people like yourself that we need to look towards to see what's coming down the track, to understand how do we avoid the tides from receding, or how do we make sure we're not that boat that as I say, all boats rise and all tides, so we're not caught with our pants down. So
right,
really important. But did I leave anything out?
I think you've covered it so well, and wish your listeners the best. It's awesome. And I think there's money to be made, and there's, the interesting thing is it doesn't matter what time it is. There's always an opportunity. You just have to know what it is, and you have to look at, what are the best opportunities today, and it's usually not yesterday's. So
exactly.
Great show, by the way. Love your show.
Thank you so much. Well, Bob, I want to thank you again for taking the time to join us on the show. Enjoy the rest of your week, and we will catch up very, very soon.
All right. Sounds good. Thank you very much.
Well, there you have another cracking episode jam-packed with some incredible advice and tips from Bob and all that he's learned over the years. And if you do have any questions for Bob and his team, please head over to aspenfunds.com, and all those show notes will be, all the links in the show notes will be in the show notes, and we'll make sure we get our hands on one of Bob's economic outlook markets, because I think that'll be really bloody good bedtime reading. I want to thank you all again for taking some time out of your day to continue to grow your financial IQ, because that is what we're all about here on this show. And we're going to do it all again next week. So be bold, be brave, and remember, go give life a crack.